Hello and welcome to the lecture for Chapter 5. This chapter deals with, overall, with the subject of audit risk and how that relates to the amount of evidence we as auditors would want to gather in the field. There's a direct correlation to the risks that exist, the risks that we're willing to take, and what we need to do to mitigate that risk in terms of how we carry out the audit. So we'll talk about different types of audit evidence, different types of audit procedures. We'll talk about the role of data analytics, and we'll talk about the purposes of audit documentation and the nature and extent of that, and then how audit working papers are built up. I would caution against a couple things in this chapter. One, the subject of audit risk is approached in a very mathematical way. What I've been told by working auditors is it's more intuitive and subjective than that. So that's one issue. And then the other issue is the examples I give you of working papers. Please keep in the back of your mind that every firm is going to have a different way of doing those, and you'd be trained at whatever firm you work at into how they do audits. So the definition of audit risk is the possibility that auditors may unknowingly fail to appropriately modify their opinion of financial statements that are materially misstated. So the client makes a mistake on the financial statements they produce. It's a material mistake that would affect people's decision making, and we as auditors don't catch it. Management doesn't catch it, and we don't catch it. We issue an unmodified or clean opinion. People rely on that information, and then it comes to light that it was wrong. That's audit risk. Another term for this quote is blowing the audit. That's what auditors would call it. So the quantity of audit evidence that we need to gather to mitigate that risk, to avoid that risk, is affected by a couple of different things. So one is, what is the risk of misstatement of a particular element of the financial statements? So what's the amount of that element of the financial statements relative to the overall financial statements? What's the sensitivity of that particular item in terms of people's decision making? And then what's the nature of the account and the assertion that management's making? The other factor is the quality of the evidence that we get about that particular element of the financial statement. So is it an original document from a third party that the company has not touched or seen? That would be the highest level of quality. The lowest level of quality is documentation the company produces. So one of the things the book talks about, and it's important to kind of understand what this means, is they'll talk about assertions. So assertions are claims that management makes about elements on the financial statement. So when we talk about the balance sheet, that's the left column of this table that I took from the textbook. One is that assets actually exist. And I'll say that because people are more likely to lie about an asset existing than a liability necessarily. So nobody's going to claim they have a liability that they really don't have in all likelihood. But are they going to claim assets that aren't really theirs or don't really exist? That's a way for them to inflate their balance sheet and correspondingly improve their income statement. So we want to kick the tires, make sure that if management claims that this asset exists, that it really does. Rights and obligations, making sure that the assets that do exist are actually owned by the company, not leased or rented or borrowed or something like that. So looking at titles, contracts of sale, those kinds of things. And then correspondingly that the obligations that are shown on the balance sheet are literally obligations of the company and not of somebody else. Completeness. So we want to make sure that all of the assets have been registered and are reflected on the financial statement, that there aren't assets there that haven't been shown. Again, that's less likely of a mistake a company is going to make. What's more likely is that the list of liabilities they have is incomplete. They haven't included all the liabilities because, again, they're trying to make their financial statements look better. So that's a tougher thing. It's one thing to walk around, kick tires of trucks or machines and look at the documents to say they really own them. It's a little bit harder to find something that isn't on the financial statements. So we'll talk about that more as the class goes on. Making sure that all of the assets, liabilities, and equity interest are properly valued, and sometimes that involves estimates and judgments. but making sure that that's done correctly and the things are allocated in a proper way. When it comes to income statement, the middle column here, we want to make sure that the transactions that they're depicting in the financial statements actually occurred, that they're not fictional entries, fictional transactions. We want to make sure that all transactions have been recorded, that they didn't push a couple of expenses into January from December, kind of a thing. Want to make sure that everything is done accurately so that they've done their math properly. They haven't made mistakes with regard to amortization of prepaid costs, depreciation, those kinds of things. If there are present value calculations for long-term liabilities, that they've done those properly. Cutoff is very important. So as an example, if your client has a year end of December 31st, we want to be very careful about the transactions around that date, making sure that anything that did occur in December was recorded in December. Anything that occurred in January actually was recorded in January in the new year. Make sure that all transactions have been classified properly. And then there's assertions about presentation and disclosure. So the notes that accompany a financial statement, making sure that they are complete, that they're clear and accurate, all of the items in the right column there. So the audit risk model deals with three different types of risk. One is the inherent risk. So it's excluding the influence of a company's internal control. What is the risk that a balance in a financial statement or a set of transactions is going to contain material errors? Oftentimes that's connected to the type of transaction it is. So routine transactions, paying the phone bill, paying the rent, billing a customer and collecting cash from them. All those kinds of things happen over and over and over again, usually done by bookkeepers, not accountants. So the risk of material misstatements on those transactions is relatively low. Transactions that don't happen very often, like say trading in a major asset for a new major asset. That's not something a company does every day. So those kinds of transactions have a greater inherent risk associated with them. Same thing with transactions that involve significant amounts of estimates. So we may talk about revenue recognition issues, kind of complicated sales, those sorts of things would have a higher level of risk. Control risk is a probability that the client's internal control is going to fail to catch something. So that we can determine that by studying the client's internal control system, looking at the documentation for it, seeing is it designed properly to catch mistakes, and then secondly, is it actually being adhered to? Some companies will have an excellent internal control system that's properly documented in a 3-ring binder in the controller's office, but nobody has seen it or heard of it. So it may be that it isn't actually working in the real world. And the detection risk, that's the risk that you as an auditor will fail to detect one of these errors. So the total audit risk is multiplicative. It's these three risks multiplied by each other, meaning if the risk is high in one of these categories, you can reduce the overall risk by reducing the risk in another category. So the risk of material misstatement in management's financial statements is the inherent risk of the account multiplied by the by the control risk within the client. So that's what we want to look at. So that level of risk of material misstatement is going to determine how much detection risk we can accept. So if we want our audit risk to be at a low level, that means if the IR and the CR are high, then the DR must be very, very low. And in order for the detection risk to be low, we need to look at more evidence, okay, or do more procedures in the field, or use more experienced auditors in the field, that sort of thing. So a little bit about audit evidence. So the sufficiency of the amount of evidence that we gather is related to the appropriateness of that evidence, or the quality of it. So one element of quality is does the evidence we gather directly relate to the assertion that's being made? So does the evidence answer our questions about that assertion? And then is it reliable? Can we depend on it being truthful? And again, here's where we want to really find information that's from independent sources, and ideally if we could get that from the source directly rather than through management, which could potentially give them an opportunity to alter that documentation. So the couple things that we'll do for audit procedures, these general categories, we'll do risk assessment procedures, so getting an understanding of the client, their risk environment, talking to management, looking at the company, reading the working papers from past audits. Those are all things we can do to kind of get a level of understanding of what the risk associated with the client is so that we can staff the audit properly and manage it properly. We'll do test of controls. That's basically looking at a client's internal control system and finding out if it works as intended. Okay, so we can look at evidence of that. We can run trial or test transactions through to see if they're handled properly according to the written controls. And then we'll do substantive procedures. There should be no S on the end of that, sorry. So one of that is analytical procedures. I'll talk about more about that in a minute. And then we'll also do tests of balances, transactions, and disclosures. That's where we look at actual transactions, look at physical pieces of evidence, all of that. So inspections of records and documents, this is kind of a list, the first three items there in order of quality, with the first one being the best. So what we really want is evidence that's created outside the client, transmitted directly to auditors. An example of that is auditors will request a cutoff bank statement, usually on the 10th day of the following month, and they'll ask the bank to send that statement directly to the auditor's offices or email. So that's information produced by a third party that goes directly to the auditor without passing through the client. That's the best. The next best is evidence that's created by a third party but is given to you by the client. So there's a little bit of a risk here that somebody might alter a document, committing fraud, but you may be able to detect that, and it's not as likely. The lowest level is evidence that's created actually by the client. Again, that's less reliable. So the other thing we need to consider is some of this information now is done by EDI, or electronic data interchange, the way companies interact with each other electronically rather than with paper. So we'll also do an inquiry of knowledgeable people within and outside the client. So we'll get a representation letter from management that states clearly what their responsibilities are and that they've given us access to all transactions. It's a bit of a CYA letter for auditors. It's done on the date that the audit report is given, but it just reaffirms that management's responsible for the financial statements and has given the auditors complete access to everything. The auditors will contact all of the lawyers that the firm deals with to find out if there is any pending litigation. That's primarily an issue that would be important for contingent liabilities. So if the company is certain to lose a lawsuit and have to pay money, we would want to reflect that liability and associated expense in the financial statement. So we'd find that out directly from a lawyer. And then secondly, we would find out information that we would have to include in the disclosures to the financial statements about those risks. So there are some risks that we don't have to record an entry but need a disclosure. We also may make inquiries of specialists. So if there are unusual classes of assets, there are asset valuation questions, we may need to hire an outsider to help us with that. We'll do external confirmations. We'll talk about that in the second half of the semester when we talk about accounts receivable. That's where we communicate directly with people about transactions with the company. We'll physically inspect tangible assets, kick the tires in other words, and then we'll observe different processes and procedures, primarily surrounding internal controls. We'll recalculate anything that has been calculated by management to make sure that it's mathematically accurate. Talked about that earlier, like present value calculations, depreciation calculations, maybe pension fund related liabilities, things like that. We'll reperform some procedures to make sure that they work as intended. And then we'll do analytical procedures. So analytical procedures involve looking at relationships between figures on a financial statement. That's done sometimes by scanning. So over time, you'll develop an ability, especially if you do quite a bit of work within one industry, you'll begin to get a sense of what looks normal and what doesn't look normal. And so scanning a trial balance or scanning a set of financial statements may cause some items to jump out to you as just not quite being right. We'll do this at the beginning of the audit to kind of get the lay of the land and see if there's anything that we want to dig into a little more deeply. And we'll also do it at the end of the audit to make sure that any adjustments that we've asked the client to make have resolved those kind of issues that we saw earlier. So the process involves, one, developing an expectation of what an account or a ratio should be. We'll do that based on either past performance of the company, based on a budget or a forecast the company may have provided to us, what they expected it to be, or in some cases we can do that with benchmarks from competitors. So we develop an expectation. Then we determine how much difference from that expectation we can accept without doing more work. That's linked to the materiality of that particular element of the financial statements, how much risk we can accept about that. And then we look at the actual balance and say, does it fall within that range that we accept? If it does, move on. If it's outside that range, then we investigate that and determine if there was an error or something done with bad intent. So analytical procedures involve trend analysis, also called horizontal analysis. So looking at figures and ratios over time, how have things changed? An example of that might be the company has always had a 52% gross profit margin. Year in and year out, it's been within a half a point of 52%. This year it's 60%. So that might be an indication that management made a mistake in over-counting inventory, which inflates their balance sheet, reduces their cost of goods sold, which improves their gross profit rate. So that would be something that would jump out to us that we would say, okay, we need to look at inventory a little bit more this year. Cross-sectional analysis is looking at the company, looking at their figures and ratios, comparisons between numbers compared to other companies, and see what is an outlier, what's different. You can do that from Dun & Bradstreet. There's various sources of information, especially pay-for sources that are pretty good. And then we'll do ratio analysis. Look at liquidity ratios like current ratio, see how it's changed over time, see what it is relative to the company's bank covenants if they have any. Again, ratios that are very close to the bank covenants would be an indication that maybe there's some manipulation going on. Leverage ratios, the most primary one there is debt to equity ratio. Look at that over time. Profitability ratios would be gross profit ratio, net income ratio, EBITDA ratio, those kinds of things. And then activity ratios would be looking at the turns in inventory, looking at the turns in accounts receivable. Again, a significant deviation from what it's been in the past would lead us to look into something more deeply. So here's an example of an income statement where we could do both horizontal analysis and cross-sectional analysis, looking at common size elements. We'll do something like this in our discussion for this chapter, so I won't go into this in great detail. So here's some more information about analytical procedures, different things that could be done, looking at inventory levels over the course of several years. Again, a significant jump may be an indication of either a mistake or fraud happening in the valuation of inventory. And again, I'm more concerned about inventory being overstated than understated from a likely mistake perspective. So data analytics, it provides us with an opportunity to look more deeply into transactions and find other kinds of problems. So most of you had Accounting 405 and have some experience with using SmartList and Dynamics, and you know that you can look at all transactions that occurred within a company. So being able to do that in an audit allows you to look for patterns that might not be clear in a trial balance or a set of financial statements. As an example, you can calculate the gap between when an order is received and when it ships and is invoiced. So if that gap is normally 3 to 5 days, and you find a transaction where it happened within an hour, that might be an indication that that was a fraudulent entry. So again, we're looking at deviations from the norm. We can also look at unusual sources of entries. Normally, the user name that's associated with a bookkeeper is the person doing the invoicing. If you find an invoice that was prepared by the controller, that might be an example of something that was done improperly. So those are different things that we can use to get information from data analytics about a client. So this is a really growing area. If you want to be a valuable member of an audit team, having some capability of knowing how to look into different kinds of accounting systems like you may have done with Dynamics is really important. So evidence for subjective areas. So what kind of estimates have been developed? Useful life of an asset, salvage value of an asset, those kinds of things. Are they reasonable? Do they kind of fall in line with what other clients of yours do, what they've done in the past, and have they accounted for those and disclosed them properly? When it comes to fair values of assets, of course, sometimes and talking primarily here about investments, the best level of getting comfort with a fair value is to look at observed quoted prices of identical assets. If the company has shares of Microsoft as part of their investment package portfolio, at the end of a term, well, I can look up on the internet what the price of Microsoft was on that particular day, so that's pretty easy to confirm. The next level is quoted prices for similar assets. So maybe the stock that they hold as an investment isn't broadly traded, so there isn't a price for it on that particular day, but I can look at what other similar companies have done. And then the lowest level of assurance about fair values is when they're unobservable. So here we get where companies do present value of future cash flow calculations to determine a fair value of an asset. Those involve quite a bit more judgment. We'll pay particular attention to related party transactions. So the client needs to first tell us who related parties are, who the major shareholders are, those kinds of things. We want to really take a close look at those transactions because they are more susceptible for manipulation. Bit about audit documentation. So the level of detail needs to be sufficient for another experienced auditor that wasn't involved in the audit, like another partner in the firm or a peer reviewer, to look at that engagement, to look at the audit working papers and understand what happened and understand what was done, the conclusions reached, all of that. That's how detailed they need to be. So again, we're going to have lead schedules and supporting schedules. The backbone of what we do is really the trial balance. So the trial balance is going to be what kind of guides all of our working papers. Everything will be related and reference the trial balance. So here's an example of a listing for the balance and the allowance for uncollectible accounts. And there's a whole series of initials and checks and all of that. And again, every firm is going to do this a little bit differently, so I don't want to get into the weeds about where they initialed it and all those kinds of things. But a firm you go to work for is going to have a way of building their working papers. This used to be done on physical paper, and they'd haul big boxes around with them and all of that when they'd go into the field. Now they bring scanners with them, and it's all done electronically. So you must retain records. If it's a non-publicly traded client, you have to retain them for 5 years. If it's a public client, 7 years. You can, of course, keep them longer than that. Again, the primary importance of this is to mitigate any risk about being sued over the audit. These working papers are going to be your primary evidence that you did the audit correctly. So lastly, a little bit about audit documentation. So there are administrative paperworks like the audit plan, the time budget, internal control questions you asked, flow charts, those kinds of things. There's a working trial balance. That's what I mentioned, the backbone. That's given to us by the client. There are lead schedules. Those are the balances behind each of the trial balance figures. There's going to be a section on adjusting journal entries and reclassification entries that are recommended that the client make. There are supporting schedules, so that's the detail supporting the figure in the lead schedule. There'll be analysis of ledger accounts, so those are a documentation of significant charges or additions to a particular account. Reconciliations, that's comparing the information from a client with the information from a third party. Computational working papers, and then corroborating documents. Those are minutes of board meetings, articles of incorporation, bylaws, important contracts, etc. So the corroborating documents and the administrative working papers, those will be part of the permanent files, so they'll survive from audit to audit. The others will be the working file for that particular audit. This one ran a little bit long. I apologize for that. I look forward to talking to you for the next chapter's lecture.